G'day everyone, welcome back to Pete's Investing. Today is June 11, 2023. This is a British pound US currency update. On the weekly and daily, we've broken up into a bullish momentum on our indicator down here, whereas on the hourly chart, we're showing a divergence, so just be careful about going long at the moment. On the weekly, first off, our triple moving average on the price chart and the moving averages on the CCI 150 are in alignment, so they're giving us a bullish signal, breaking up from a neutral signal last week. So that's a positive. On the daily, likewise, it's just broken up into a bullish momentum, but after a few days of, again, neutral positioning. Also notice it did bounce off the 38% level back here, the price, and it's now approaching this key resistance at 126.79, so we'll see how far it goes. And just as a matter of fact, it's actually broken on that smaller Fibonacci range. It's broken up there past the 61%, which is always a key area to look out for. You can see there on these days it actually bounced off that 61%, but that wasn't good enough for the bulls in the market, and it actually broke above that in the last couple of days, and now it's currently just below the 78% Fibonacci retracement. So that's a positive, and hence the bullish signal on our indicator as well, with both the CCI and the price moving averages aligning. However, on the hourly chart, I've drawn here a bearish divergence on the CCI versus a bullish divergence on the price chart. And if you can see, if I move that up there, that's also continuing to the downside on the CCI and moving further highs on the price chart. So what that's potentially looking at is a retracement to the downside possibly. So these generally work out, and sometimes they fail. Most of the times they work. Let's see if it does work, let's see where it may end up. So what we do is we draw a channel between those highs and bring it down to the lowest candle within that divergence range. And what we do next is put in a Fibonacci retracement. It's a very small one in this case. That'll be below that recent low. That recent low there to that current high. You can see there, if it breaks below the 61%, then that's going to be definitely a bearish signal. But let's look at it potentially where it may end up. Now, it depends how long it takes to get there. It could take a few hours, or if it drops dramatically, or it could take even a few days to actually wind down in this channel, possibly, if it does come to the downside. So for this to work, we need to see the CCI continue to the downside, and then we need to see the price also start collapsing. So our initial target area, if it breaks below this channel, will be, let's assuming it breaks out here somewhere, that'll be the first target level. And then subsequently, if it breaks below that, we'll put in a secondary level between the 78% to the 88%. So our initial target will be the 61% if it breaks below. Otherwise, if it breaks below that, we're going to see further declines. As I said, if it works, we need to see the CCI break continue to the downside and the price also collapse. Otherwise, we may, if the price continues to rise and the CCI rises, then this divergence has failed. So don't enter anything yet, of course. I usually use these as a potential for a reversal. So if I was going long based on the weekly and the daily and the hourly here, I'd be very cautious about holding those positions. You may want to actually take your profits if you were going long and see what it does. Of course, it could go higher. And that's what I've got here in this backtest trading. I've got these this long position backtest, and it's also this short position backtest. So you can see here, during the price decline, we averaged down our positions as the price was declining. We don't use stop losses, and that would have been a nice area to go short. You can see all those single entries made. And then once the price started moving to the upside, the short position started to average down, and the long position started to improve profitability. So to avoid these average downs, the way, again, as you do it, as I said earlier, you need to make sure that the weekly and the daily align. So you can see here, during that period between around March 23, that was around March 23, those long positions, you would have aligned those long positions with the daily, and likewise on the hourly chart as well. Alternatively, during this shorting positioning back here on the weekly, you would have made sure that during those shorting positions back there on the daily were also aligned with the weekly, and they align with the hourly as well. So to understand how to trade this and other trading strategies, reference the links in the description below. Subscribe to my Patreon page, where we also do weekly scans of stocks, currencies and commodities. Subscribe, like and share the channel. Thanks for watching, and see you in a future video.